when you look at real estate, Al, there's cash on cash and there's a cap rate. We haven't talked about this in a while.
Right.
Let's kind of break this down, because I think people like our friend Susan in Florida, buy what you know. I love real estate, and hey, which is perfectly fine. But does she really know anything else in regards to how she would compare that to?
Yeah, that's a good point. So let's start with cap rate. That's very simple. So that's just going to be your cash flow without regard to any debt that you have. So principal and interest, take that off the table. So whatever your cash flow is, divided into the value of the property. Okay, and in San Diego, where we're from, it's common to have a cap rate on a single-family home rental of about 3%, maybe 3.5%. Not a great cash flow vehicle, but that's roughly what you're getting. Sometimes it's less. Generally, the more expensive the property, the worse the cap rate is.
Because you're dividing your cash. So let's say you're getting $4,000 a month in rents in this $2 million place or $1 million house, or I'm in Florida, I'm getting $3,500 in rent for a $500,000 house. Right. So then you can look at, all right, well, what am I really receiving in regards to cash flow? And you just divide that into the market value to look at, all right, well, what percentage is that? Is that 1%, 3%? And then you can say, well, can I invest my capital in an alternative vehicle that I believe could do better than 3%? So that's kind of how you want to compare, any type of investment vehicle. If I'm looking at CDs to municipal bonds to real estate to individual stocks to an ETF to a mutual fund, you're looking at the growth potential of the overall investment, the income potential of the overall investment, the tax benefit, if there is any, right? Then that's going to equal your total return. So, I remember, back, Al and I have been doing this show now way too long, but in the credit crisis, people were like, I love my real estate because I can drive by and look at it.
Sure. And then it went way down.
All right, drive by and look at it now. I mean, what's it worth? It's worth half.
Yeah. I'm watching it go down.
Just watching. My house is still there, but it's worth half. All right. So, is that a reason to own it, right? Because you could drive by and look at it? I don't know.
Well, so you bring up a good point. So cash flow is not the only rate of return. It's also appreciation and tax benefits, debt pay down, and so forth. And so to me, here's a mistake that some people make when they say, I'm never going to sell my real estate because it's such a good investment vehicle. But then their only benefit, if that's the case, is the cash flow, which maybe it's 3%. I'm not saying that's bad, but that's what you're getting. So what about all the appreciation? Well, it's appreciating 4 or 5% per year. That's pretty good. It is good, but who's going to get that?
Right.
Your kids. And as long as you understand that, that's because you're not going to get it if you never sell. Your kids are going to get it. So basically, you're doing all this work, building all this equity for your children, and maybe that's your goal.
Exactly. So is the goal really to be, all right, well, I want to leave a lasting legacy to my overall heirs. Right. Okay, that's a perfectly great strategy.
Sure.
Or is your goal, I want to maximize my overall retirement income? You can still do real estate. It's not like we're telling you to sell and go into a stock portfolio, but you look at the equity and then you're like, okay, well here, I've accumulated a lot of equity. Maybe I can upgrade now. Maybe I can 1031 exchange this into multi-unit, right? Where historically you might be able to get a better cash on cash return. Maybe you look at apartments. Maybe you look at, there's multiple different vehicles that you can look at. I guess my point is that you have to examine each of your, investments and just understand what your total return is on it. Then you can make better decisions, I think, versus emotional decisions.
Sure.
Because she has an emotional attachment towards those properties because, hey, I bought these, I know them, I want to give them to my kids. And guess what? When we hit the pearly gates and when we die, you know what? They get a full step up in tax basis. So they won't have to pay tax. They hate real estate. They'll sell it the next day. Boom. That's her, quote unquote, Roth strategy to get tax-free dollars to the kids. Perfectly great strategy because now she's just leveraging the growth for the kids and not necessarily participating in that growth for her and her husband.
Yeah, and of course, it's always there if you need it. Like if something comes up in your life where you need more capital, you can sell the property, you can fall back on it. Joe, I'll just briefly say cash on cash. That's just simply your net cash flow after your loan and interest, whatever that is, divided by your equity. So the property's worth $500,000, the loan is $400,000, so you got $100,000 equity, and your cash flow is, $1,000, right? So you divide that into the 100,000, you have a 1% cash on cash in that particular example.
Yeah, so I mean, you're looking, cap rate is the total market value of the overall property or the asset.
That's right, divided by the cash flow, not including principal and interest.
And cash on cash is taking cash flow divided into your equity.
Exactly. Now, some people add back the principal because they figure they're paying down debt. There's different ways to look at it, but at least in Southern California, unless you put a huge down payment down, your cash flow is not positive; it's negative, right? So, and it's negative now. What's going to happen when something goes wrong with the property or the economy changes and it's hard to get the same rents that you were getting? Just be aware of these things. A lot of people have been hurt, myself included, on this strategy. That's not to say I actually love real estate. I still have 3 rentals. I love real estate. Just understand what you're doing and what the risks are.
Yeah, because you can make a ton of cash. I mean, we get a lot of fire questions, from people that are looking for passive income.
Right.
Who was that one? I'm not going to say anything derogatory about him, but I guarantee he's filing bankruptcy.
Yeah, I remember who you're talking about.
I know who you're talking
that
about.
Blogger, right? I guarantee that guy does not have a blog. I don't even know why he was on our show.
I'll see what I can find. I'll see if he's still around.
Right?
Well, and the problem with that approach.
What the approach was, he was just leveraging. So it's like, here, I bought this one property for $100,000, and I put 10% down, and then the market went up, and then so I refinanced. I pulled some dollars out of this rental, and I put that as a down payment for another one, and then I'm leveraging up this one, and I'm buying this one, and so I got this great big large portfolio, but I'm fully levered to high hell, right?
Yep.
And then the market turns a smidge. You have a vacancy. Something goes wrong, right? Your house of cards blows up.
It blows up. It's happened to almost every real estate guru out there. It happened to me to a certain extent, and I kind of read this stuff, and I thought, this wouldn't happen. I'm in Southern California. Properties don't go down. And then the Great Recession hit, and properties went down 25, 30%. And we're in San Diego where we're living, and so, and I had some properties in Las Vegas that went down over 50%. And all of a sudden, your loan to value, your equity, goes from a nice positive figure to negative. Your value is less than your debt. And, you have trouble paying the mortgage because you can't charge the same rents because no one has money.
No one has a job.
Right. It's like, just factor all this in.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.